Greg, I mean, I don't know if we can make too much of this inflation story. It's only gas, food, housing costs, healthcare, travel. I mean, when does it hit stocks?
Right. You know, as you intimated, we haven't made enough of it. You've talked about one area in which the inflationary pressures are metastasizing. The others I'd have you look at are metal, cement. Energy is a primary component in the production of those. And like you said, in Europe, we are facing the shutdown of some of those plants where production is now not economically viable. And so that will decrease supply of raw materials that are sorely needed. It will certainly increase the price. And so I am looking for 6% CPI plus this year. I am looking for 5% PCE plus this year. That is not priced in. Every single factor that led to that sell-off last week, a week ago today, is only going to get more acute, is only going to become an increasing headwind. And I think we're going to start hearing that on these third quarter calls as the companies talk about margin degradation, as they complain about raw material component availability and pricing, as they talk about continued wage pressures to the upside, and as they talk about energy prices. So I think we're nowhere out of the woods yet.
Yeah.
And it has me very cautious about what sectors I have exposure to.
Yeah, and let's tie that all together back to the markets, right? Because I know it's, listen, so input costs go up. Then consumer prices, to your point, the CPI, Consumer Price Index, it goes up. There's two options. Companies can either pass along most or all those price increases to you and I, right? So our purchasing power goes down. Or they probably do something in the middle, right? They raise prices a little bit, but then they also have to eat that, which means if they don't cut costs, maybe people, their margins are going to go down and their stock prices may go down. How does this ultimately play out in the equity markets, Greg?
Right, and I think you've intimated at it here a bit. What you want to be looking for right now are sectors that do have the ability to either pass costs on or have insulated themselves with long-term contracts or aren't as acutely exposed to some of those pressures. And so the financial services industry, for example, although we'll be looking for some loan growth, which will probably be in short supply when big banks report this week. But as we've seen over the last 12 months, those large integrated banks have been making a killing in capital markets, have been making a killing in investment banking. We expect that to continue, even if the net interest margin environment is probably at an inflection point, but may plateau here for a quarter or two. Some of those energy companies we talked about have the ability to pass on that pricing. So we'll see some margin integrity there, particularly as production response or supply response hasn't been as immediate or sizable as we've seen in the past. And so the key is to look for those sectors where they are somewhat insulated or certainly not as exposed or have the ability to pass that pricing on to consumers.